It's fundamental, isn't it? A healthy economy really relies on a healthy banking system.
Absolutely. You can't separate the two.
And for anyone listening who wants to stay truly informed, understanding the real strength of the biggest players in that system, it's pretty crucial.
Agreed. Their performance isn't just numbers on a page. It affects loans, investments, everything. Tangible impacts.
Exactly. And that's what we're diving into today. We've got some really interesting data here looking at the 5 largest U.S. banks based on their assets as of May 12th, 2025.
The heavy hitters.
Right, we're talking Bank of America, huge, 3,261,519 million in assets. Then Citigroup, 2,352,945 million. Goldman Sachs, 1,675,972 million.
Still massive numbers.
Oh yeah. Then the leader of the pack, J.P. Morgan Chase, at 4,002,814 million. And rounding out the top 5, Wells Fargo with 1,929,845 million.
Those figures really just underline how dominant they are in the U.S. financial scene.
So our mission here today, our deep dive, is to look past just those big asset numbers. We want to understand their strength as a group, how they stack up against each other.
See who's particularly strong in certain areas.
Yeah, and maybe get a sense of how resilient they might be if the economy hits a rough patch. We're focusing on data from 2021 through 2024.
A recent snapshot. Okay. Where do we start?
Let's start with financial stability, kind of the bedrock, right?
Makes sense. And a key measure for that is the assets to liabilities ratio. Basically, do they have more stuff than they owe?
Simple concept, vital number.
Yeah, you want that ratio above 1.0. That tells you they have enough assets to cover their obligations. It's a fundamental check.
Right, and looking at our first table, the data shows that all 5, BAC, Citi, Goldman, JPM, Wells Fargo, they all kept that ratio above 1.0.
Consistent.
Consistently, right through from 2021 to 2024, 4 years straight.
Okay, so that's a basic level of stability across the board then.
It seems so. So maybe we give each of them a point for that, for demonstrating that baseline financial stability.
Sounds fair. It lays a good foundation. You do see some minor ups and downs year to year in the exact ratios, but yeah, always above 1.
It does make you wonder, though, like you mentioned offline, if a ratio gets too high, does that mean they're maybe not putting assets to work aggressively enough?
That's a valid question. There's a balance between safety and efficient use of capital. But for this basic check, they all pass.
Okay, solid foundation. Table 2 lays out the revenue numbers for each bank, 2021 to 2024, and the total for the group.
Okay. Looking at the total.
Yeah, what jumps out?
Well, the combined revenue for all 5 generally went up over the 4 years. There's a little dip there in 2022, but the overall trend is upwards.
It's just the overall pie was growing, maybe?
Huh?
Or they got better at capturing it?
Could be both. Expanding market, maybe successful business lines.
And if we look at the individual banks,
Well, JP Morgan Chase. They're consistently pulling in the highest revenue each year. Just sheer volume of business.
clearly the leader in generating top-line income. All right, let's dig a bit deeper into that growth. Table 3 gives us the year-over-year percentage changes in revenue and the average annual growth rate.
Okay. This view often shows more volatility.
Definitely. Anything stand out here?
Well, Goldman Sachs jumps out immediately. Look at those swings. Big drop in revenue growth in 22 and 23, then a huge bounce back in 24.
Wow, yeah, that's quite a ride.
It likely reflects how much of their business is tied to things like investment banking, trading, activities that are really sensitive to market conditions.
Right. Feast or famine sometimes in those areas, relatively speaking.
Exactly. Now, on the flip side,
Let me guess. JP Morgan Chase.
you got it. Not only the highest total revenue, but also the highest average annual revenue growth rate over the period, 11.88%.
That's pretty impressive growth for an institution that large.
Yeah.
Consistent high growth.
It really is. It suggests maybe their diversification across different banking areas helps smooth things out and drive overall growth.
Okay, so another point for JP Morgan Chase then for the highest average revenue growth.
Agreed.
Now, speaking of getting bigger, let's look at market share. Table 4 shows what percentage of that total revenue pie, just among these 5, each bank captured each year.
And this trend seems pretty clear, too.
Yeah, it really does. JP Morgan Chase again.
Mm-hmm. They started at just under 29% market share in 2021 among this group, and by 2024, they'd grown that to over 34.7%.
That's a significant gain, taking share from competitors within the top 5.
It shows they're not just benefiting from overall market growth, they're actively outperforming their direct large competitors, a strong competitive position.
Right. That consistent gain in dominance feels like it warrants another point for JP Morgan Chase.
I'd agree. Growing market share in that kind of environment is a clear sign of strength.
Okay, let's shift gears now to profitability. Really important for investors, obviously. Table 5 shows earnings per share, EPS.
Right, EPS. Basically, how much profit the bank makes for each share of its stock out there. Higher is generally better, meaning more profitable.
So what does the data tell us here?
Well, this is interesting. Remember the revenue volatility we saw with Goldman Sachs?
Yeah, the big swings.
Despite that, they consistently had the highest EPS among these 5 banks throughout the whole period.
Really? Even in the years their revenue dipped.
Yes, even in 2022 and 2023, their profit per share remained top of the group.
Huh. So that suggests they're incredibly efficient at turning revenue into profit. Or maybe their profit margins are just higher in their lines of business.
Could be a mix of both. High efficiency, profitable business lines. It means even when revenue fluctuates, the profitability per share holds up relatively well, at least compared to peers.
Fascinating. Shows revenue isn't the whole story. Okay, so a point for Goldman Sachs for consistently high profitability based on EPS.
Seems right. Highlights operational strength.
All right, so if that's profitability, what about the growth in profitability? Table 6 looks at EPS growth year over year and the average.
And right away, you see a lot of jumping around here, volatility across the board.
Yeah, nobody seems immune to swings in EPS growth. What drives that typically?
Oh, lots of things. Broader economic conditions, interest rate changes, loan loss provisions, strategic decisions, even share buybacks can impact EPS growth numbers. It's a dynamic figure.
Okay, so lots of movement. But looking at the average growth over the 4 years.
Well, amidst all that noise, one bank does come out on top for the average growth rate.
Let me guess again.
JP Morgan Chase. Highest average growth in EPS at 11.55%.
They're really racking up the points here. So another point for JPM for leading average EPS growth.
It suggests an ability not just to be profitable, but to consistently increase that profitability over time, on average, despite the yearly fluctuations. That's key for long-term health.
Definitely. Okay, we're nearing the finish line. Let's look at valuation. How is the market pricing these banks right now? Table 7 shows the price to earnings, or PE ratio.
Right, the PE ratio. It tells you how much investors are willing to pay for $1 of the company's current earnings. A higher PE often means higher growth expectations, while a lower PE can sometimes mean it's seen as undervalued or maybe facing lower growth prospects.
So what's the story here with these 5?
Well, what's really striking is that all 5 of them currently have PE ratios well below 20.
Okay. Is 20 like a general benchmark?
It's often used as a rough gauge for the broader market, though it varies hugely by industry. But for large, established companies like these, PEs under 20 are generally considered relatively low.
So the market isn't paying a huge premium for their current earnings right now.
It seems not. It could mean the market is cautious about the banking sector overall, maybe expecting slower growth. Or it could mean these stocks are potentially attractively valued.
Interesting. Multiple interpretations possible.
Always. But the observation is they're all in that lower range.
Okay. Well, given that all 5 share this characteristic of having relatively low, potentially attractive PE ratios right now, maybe we award a point to each of them for that.
Yeah, I think that's fair. It's a common feature across the group currently. A point each for current valuation.
All right. The moment of truth. Let's tally up the points based on the metrics we've walked through. What about Goldman?
Goldman Sachs. 1 for financial stability, 1 for that consistent high profitability EPS, and 1 for the current valuation. That's 3 points.
Okay, 3 for Goldman.
Wells Fargo, 1 for financial stability and 1 for the current valuation. That's 2 points.
Right, 2 for Wells Fargo. And the leader.
And leading the pack, JP Morgan Chase. 1 for financial stability, 1 for the highest average revenue growth, 1 for dominant market share, 1 for the highest average EPS growth, and 1 for the current valuation. That's a total of 5 points.
Wow, okay. So based on this specific analysis, this dive into the 2021-2024 data, JP Morgan Chase comes out looking the strongest across these particular metrics.
That's what the numbers suggest for this period, yes.